Hi, JJ here again with The Art of Value. Welcome. Well, today we're going to look at a fireside chat between the great Charlie Munger and Todd Combs from last year, April last year. It's always good to hear what Charlie Munger's got to say. He's getting really old. There won't be too many public conversations with him left. It's good to hear what he says about investing and life in general. So let's get straight into it. Your time is valuable. This fireside chat was from the Singleton Prize for CEO Excellence in April 22. The audio on the original is pretty bad. It's hard to hear what he's saying, but I still will provide a link to it in the description. Also, I'll put a link to a Substack by Frederick Geishen, which he has highlights on there, longer highlights than I will provide today, but he's gone through the interview as well and put highlights, which is really helpful. The first one's on the nature of capitalism. Munger says he's seen a lot of businesses decline. These capitalist enterprises rise and decline over his long lifetime. So businesses don't last forever, and there are a lot of reasons for them to decline. He says GE's decline has happened pretty recently, and that was because of wretched excess, which a lot of companies fall victim to over the time. Their CEOs get into debt. There are many different reasons, but that is one example that he gave. He argues that one business from the old days still stands strong, and that the Rockefeller Empire, in different form of course, but it's still going strong, but there aren't many businesses like that today. The second topic's on the chemistry of booms and busts. He says that capitalism is a self-perpetuating process which speeds up in booms and in busts or depressions, where you can see things speeding up to the upside and to the downside. They're both bad, he says, they're both dangerous, but he sees there's danger around today. And of course, he's talked about this wretched excess, so it leads on from that. He says a lot of wretched excess around. He's talked about Bitcoin and meme stocks and all these kinds of things. Inflation, he says, inflation won't be my problem, but it might be yours. And he says that politicians often print too much money, and it's been okay for civilization so far, but he thinks there's a problem coming down the line. He says it can lead to the problems that the Weimar Republic had with hyperinflation, and that could happen, but he doesn't think he'll be around to see it. He's getting very old. He's nearly 100. The next one's on investing intelligence versus temperament. He says that Warren Buffett, his friend and partner Warren Buffett, says that you don't need to be super intelligent to be a great investor. You do need to have the right temperament, though. He says a lot of people get unstuck having the wrong temperament. He says with the right temperament and long-term focus is very important, which is what Buffett and he have had. You can do very well, but you do have to have that long-term focus. A lot of investors don't have the right patience for it. It's important not to be swayed by FOMO, which is very difficult as a period we've just seen through, but Buffett and Munger waited it out as usual, and they've been buying up big. Just in the last year, as we've had a bear market, they've bought up big after not buying very much for quite a few years, or just buying back their own Berkshire shares because they were good value. By the way, if you're enjoying this episode so far, getting value out of it, please hit that like button on YouTube or Rumble to help spread it to more people. Thanks, I really appreciate it. The next point, as Munger points out, is that you only need one or two great businesses. You only need to find one or two great businesses in your investing career to do very well. A lot of people buy too many and not research and not do the work to find these great businesses and be patient before you find them. He talks about Home Depot being one of these, and Berkshire itself. If you had invested only in Berkshire and a couple of other businesses, you would have done very well over time. But he says you really just need to find one or two and be patient in that. That's all it needs. So to spend that focus, have that focus to find the great businesses, be patient and invest in those great businesses, you'll do very well. In the last video I did, I was talking about 100 baggers, focusing on finding those winners, those big winners over time and sticking with them for 20 to 25 years. There'll be 100 baggers, but you have to wait that long, on average 20 to 25 years. I'm going to put a link to that at the end of this video if you want to go back and see that. It's really worth seeing as well. The next point goes on from that and is related. He talks about the secret to life is having an obsession and a long attention span. So focus on one obsession. In this case, it's investing, finding great companies, and really focus on that. People get way too distracted on this and that, and maybe before finding success, but to have that focus to see things through for the very long term. And he's proof, have a long life and become multi-billionaire, he and Warren Buffett, by having this singular obsession to find these great businesses, buy these great businesses, and just hold on to them. They do sell things if they've made a mistake, and everybody does make mistakes. He has said that elsewhere. You've got to admit mistakes, but really to have that focus to find these great businesses and just hold on to them. Charlie said his life changed at age 7 when he realized that humans were irrational and that maybe he could be more rational and he could do very well just by trying to be rational. He gives the example of his father's friend who was a mathematician at the University of Nebraska, and one day his house was leaking and he went berserk, kind of lost his mind over it. He was acting irrationally and he realized even geniuses could be irrational, and that if he acted rationally and in terms of investing later on, he could do very well compared to others. So there's a lot of irrationality in the market. This is me saying this. We can see bubbles and a lot of irrationality, FOMO, etc. So he and Buffett have prided themselves on being rational in these markets when everybody else is going bonkers, berserk, that they are rational when they come out on top in the end. They just have to wait and be patient. So there's a lot to do with just being rational, trying to be rational when humans are really emotional. Related to that, Munger says he almost worships reason. He thinks it's really important to become wise by studying and thinking. And he was influenced by his grandfather, who he said was a self-made genius who made very few mistakes. So Munger says in the next point, look for the Wooden system, meaning Wooden was a baseball coach who concentrated 100% of the time on his top 7 players. And he relates that to people like Buffett. Buffett concentrates capital in the top players, the top companies, the very best. If you look at their stocks that they own, they have concentrated in the top stocks. Why look for the next best level when you can put more money into the top stocks? Look at their concentration on Apple and other companies, but he also talks about it in terms of people. If you were to invest with Buffett, a lot of money with Buffett, and look for other people like that, other investors like that, and go with them. Look for these special companies and these special investors and put your money with them. You'll do very well. So he's talking about this Wooden system of concentrating at the top, at the very best, rather than diversifying through many that aren't so good. Why not put money into your best picks rather than the 5th, 6th, 7th, 8th string, or down to 20 or 30 stocks? Some people have way too many stocks. Well, this is what I got from this point anyway. What do you think about these points about concentrating capital? How many stocks do you own? Do you think it's 20 or 30 is best? Or do you think 5 to 10, say, is better to concentrate that capital? Or invest with somebody who you know, like Buffett, is going to do well with your money over time and give more money to them? Or do you think that an S&P fund is much better? I certainly think that if you don't know what you're doing, if you're starting out and investing, S&P 500 fund is probably good. That's just my opinion, not advice, but Buffett gives that advice. He says if you don't know about analysis or you're not really interested in investing, just putting money into the S&P 500 will do you well, because it's got a really good average over time and it's really hard to beat. When people say beat the market, that's what they mean, the S&P 500, and it's really hard to beat over the time, and Buffett's beaten it, and Munger have beaten it with Berkshire over the very long time, over more than 50 years, more than 55 years now, getting 19% over that time, which is incredibly good. So do you think it's best to concentrate, or do you think it's best to have a diversified fund? What do you think? Let me know in the comments. So next, Munger talks about looking for people with the fiduciary gene, and what he means by that is really honest people with honor and pride. And he talks about George Washington, who left power voluntarily, so not clinging to power. And in terms of investing, he's talking about looking for those people with honesty, with honor, who will do right by shareholders, I think. So if people are putting money with a certain investor like Buffett or Munger, you have to really trust that they're going to do well with your money and that they're not going to cheat you out of it or enrich themselves. They've got that fiduciary gene. Very important to look for. So next, he offers a little perspective on life. He says today we've got it pretty good compared to, say, 200 years ago, where today medical facilities, medical science is so much better. There's such a high mortality rate back then and a low mobility and many other things we take for granted. People are pretty pessimistic about the future now, but compared to 200 years ago, and remember, he's nearly 100, so he's seen a lot. He's seen a lot of changes. He thinks that we've got it pretty good now, and we should not take that for granted. As I said earlier, if you're on YouTube, I'm going to leave a link up here to a video about 100 Baggers. Chris Mayer's book, 100 Baggers, made a video about that in terms of looking for these great companies to find and sticking with them over a long time, which Buffett and Munger have been expert at over their career and patient at. So I'll put that link there and in this description for people who aren't on YouTube as well. Thanks for watching and listening. I hope you found value in it, and I'll see you next time.